Hello and welcome to Upside, where every week we look behind the headlines affecting European venture. Today, we are not in a sweaty office like Mads. We are in Lisbon, your hometown, Lomax.
We are right on the Atlantic, on the frontier of Europe. Frontier investors, frontier location. Mads is back in the studio. We are here, about to go into the Outside Ventures office to record our thing. And it's great to have you here, BB.
Love to be here. And what have we got happening this week?
We have latest on the Chinese models and export controls.
We have got pensions. We're going to take a look at what's happening on UK pension front. We're also looking at, is it 1999? How big is the AI bubble and when is it going to pop?
Or is it not? And we also have dealer predictions and predictions.
Okay. Let's get into it.
Full docket, let's go.
Gentlemen, before I get into some quick news, how are you both? Mads, how are you doing?
Fabulous. Had a couple of days in Copenhagen. Always a beautiful city this time of year.
Hometown, right? Home turf.
Absolutely, yeah.
Nice, nice. Is it as hot there as it is in the UK?
Do you know, it was super pleasant, mid-20s, blue skies, very nice.
Take it. And Lomax, I'm with you, even though we are in opposite meeting rooms because we couldn't get the mics to work. But we are on the beach in Lisbon. How the heck are you, sir?
Welcome to our home. It's a pleasure to have you here.
I'm loving it. It is surfer's paradise, and people can't see, but I'm looking at skateboards and surfboards. Do you get any work done?
Occasionally. We're stereotypical VCs, really. So we're living up to the stereotype.
It is lovely. It is just lovely being on the beach, and it's lovely to be here with you.
We are away from the noise, contrarian thinkers, living on the frontier. You know.
I'm going to chime in with some quick news, some stuff that we're not going to cover in the main sesh. There's a lot happening this week. It's been a very exciting week in our world. We saw Grok 4.5 launch with Cursor. All three flavors are out of ChatGPT 5.6. Nvidia shed 1 trillion, but we're going to talk a bit more about that in a second. China may block foreign access to its own models. Blue Origin is now out raising 10 billion. PX is down 46%. Pension cash, is it finally getting into the UK venture scene? We are going to talk more about that later because that's quite interesting if it's true. All of this against a darkening Iranian backdrop, which I'm sure everybody has seen in the news. Quick fun fact before we do some quick news. Despite shedding, Nvidia stock price is actually up 1,500% since ChatGPT launched. This week, the OBR has warned Burnham, who is now, I think he got 322 votes. He only needed one more vote, and then it was a shoo-in, but he missed the no one can run against him vote by one, but he is obviously going to be the next UK Prime Minister. The OBR has warned him to cut spending. Don't know how he's going to do that with his triple lock promise and, but we'll see. According to Deal Room, UK startups raised 17 billion in H1 2026, more than double a year ago. Well done, UK. We saw 4 big mega rounds over $1 billion. Isomorphic Labs, Nscale, Wave, and Ineffable Intelligence. The UK tech scene, did you know, gentlemen, is now worth $1.7 trillion. Lovely. Apple lost its case against the EU. They were trying to stop them being so monopolistic. I'm sure they will appeal. And here's one that I mentioned this last week, but another move into on-device AI. Prism ML has shrunk the Qwen 3.6 open source model designed by Alibaba to run on an iPhone 17 Pro. So that is all 27 billion parameters active simultaneously, which I think is a big deal. Anything in that? Actually, Matt, you wanted to talk about some kind of tying up of some loose ends from last week. Give us your scoop on last week's chat.
That was a great roundup, Dan. Thanks for that. I mean, there were a few things we mentioned last week to watch out for this week, and one of them were the Tesla deliveries. We sort of said, look, watch out for what's happening there with Tesla, given the competition from China. The consensus was that they would ship and sell 400,000 vehicles in the quarter. They ended up shipping 480,000, so absolutely
amazing.
Smashed it. First turnaround print in 2 years, and a lot of the demand came from Europe. So make of that what you will, but certainly some tea leaves to read.
I'm really surprised.
You're not the only one, and look, who knows, right? But interesting to see. We also talked about SpaceX, which did enter the Nasdaq 100 this week. They're in at under 1% weight, and it only led to about 5 billion of forced buying. The stock moved less than 1%, so there was kind of a fully front run Everybody had participated and had bought the shares in advance. So the inclusion was not an event. In the end, all that stuff happened ahead. Samsung also released their profit. They had a 19x increase in profit for the quarter. Their numbers exceeded all of 2025, and yet the stock fell 8%. So the markets have, as we spoke about, massively. The market has simply stopped paying for records. And we've talked about how kind of there is this thought that maybe, possibly, some people are starting to see a top of this market here. I'm sure we'll unpack that more. In the week, we also had Race Paris, 9,000 people at the Louvre. Macron, he was talking about AI sovereignty, and there was the Machina at Station F, sorry, not X in France, it's obviously F for Vive la France, which was Europe's first physical AI summit. It's pretty cool that. Volkswagen, we talked about, we're discussing at the board level the big redundancy plans this week. No decision yet, but it is still being discussed, and they're talking about closing up to 4 plants. There's an investor call on Monday, so expect to hear more on that over the coming days and weeks. TSMC earnings are this week, but they haven't been released yet at time of pod, so we're certainly waiting for those to see what comes out. Exactly that. So that was sort of the roundup.
Thanks for that, Max. Lomax, Burnham, what are your thoughts on any thoughts?
Yeah, just you mentioned it quickly in the quick news, but it's worth touching upon this this OBR. Our friends get very dry off budget responsibility. The report they issued this week, because it's actually pretty sobering. They basically said that spending cuts or tax rises equivalent to 100 billion a year. That's basically 10% of the budget would be required to stabilize debt at 95% from 2030 onwards. And we're talking about the backdrop here being we've been trying to find up to 16 billion for defense. And we're now talking about, the OBR are talking about finding 100 billion. I think it's insane. On current policy, they're saying Britain's public debt would move on to an unsustainable and ever-rising path in almost all scenarios as pressure rises to spend more on health, social care, and the state pension. The main exposure, of course, is there's more borrowing, and then if higher interest rates rise, that's the real pressure situation. The UK is currently spending, like 90 to 100 billion pounds a year on interest, but
which they will, right? I mean, we are going to be seeing interest rate rises.
And the debt to GDP in the UK is 45% higher than the average for advanced economies. It's actually pretty damn sobering against the backdrop of Andy Burnham coming in and talking about a 10-year plan of effectively trying good growth, whatever the hell that means, Manchesterism again, whatever the hell that means, but also actually spending more. So I'm a little bit perturbed by that report, and it's they're basically saying they expect government on current trajectory, government spending excluding interest, which is currently 40%, will go up to 50% in the next 30 years. It's nuts. Healthcare spending, which is currently 8% of GDP, will basically nearly double to 15% in the next 30, 40 years. So these are big problems that the UK and other European economies face. And I think we are probably aligned that we think technology is the answer here. The main issue, of course, is aging population. This is all driven by that, higher welfare costs, higher healthcare costs, and higher pension costs.
Gosh, we are called upside, you know that.
Well, I just said the upside there is technology,
You could have snuck it in at the end.
No, but I think it's very sobering, and it's we need to be aware of this.
I know. I just don't know if he's going to face it head on. Obviously, being slightly left of Starmer is going to mean spend and look after people and welfare and triple lock and health and NHS. So I don't know how he's going to have the same conversation or in the same breath. It's going to be a tough one. We'll see what he comes up with. Can't distribute your way out of that. But no, reallocate, whatever he's famous for doing. You also had some notes on OpenAI, Lomax. I don't know if you want to dig into that.
This is just around the public launches of their that they announced this week on Thursday.
Because they were going to be closed shop, weren't they? They were going to be partners only, and then I think the American government gave them permission to launch to the free world. So
yeah,
as of yesterday, time of pod.
This is Sol, Luna, and Terra. the variants of ChatGPT 5.6. They sound like kind of footballers' kids, don't they, or something? No? But I think it's just worth stepping back. This is an uncharted new world now. We're in a world where cutting edge technology companies are basically getting all of their new releases blessed by the government. It's currently a voluntary arrangement, but this is a completely new world. No, imagine back in the day if Apple releasing new software would actually be require government approval and oversight. It's a sign of the times that we live in.
And let's talk about China and AI. So let's talk China, saying it with a Trumpian accent. In February, people may not know that Chinese AI models actually overtook American models. Now, not on benchmarks, but on usage. On OpenRouter, which is the biggest routing platform for AI models, Chinese models processed 4.1 trillion tokens in 1 week, against the American models, which was 2.9 trillion. The year before, America had 70% of that platform, and today the most used model in the world is from Xiaomi, who's the phone company. So keeping in mind that half of OpenRouter's users are American. So US developers are understandably ignoring the politics, looking for bang for buck. Why wouldn't they? Near frontier performance at 1/10 of the cost. So how did China close the gap so quickly? We all probably know that there is a little bit of naughtiness going on. Anthropic told the US Senate last month that Alibaba's Qwen lab ran 29 million exchanges with Claude through 25,000 fake accounts, harvesting the outputs to train its own model, the distillation piece. Now, Beijing is considering restricting foreign access to its own top models. So what they're doing is they're distilling the competition, gating the models, and now potentially locking the door. Pretty genius, an old Chinese playbook, but what does this mean for Europe? Mads, this was one of yours in the docket, and I know you know a lot about this kind of stuff. How would you position this?
What does it mean for Europe? What does it mean for the world? I think the scoreboard is super interesting. You had some token stats. I think they were from February. Today, we're looking at 18 trillion tokens to 5.5, so 3 to 1 on OpenRouter. What does that mean? It's widening. 61% of all tokens that are routed through OpenRouter go to the Chinese open-weight models. And yes, you're absolutely right. Lots of talk and discussion about distillation. The American Senate, the US Senate is accusing the Chinese model developers of distilling the US models. And in return, the Chinese are saying, well, maybe we're just not going to use your models anymore because we don't like what you're saying. And by the way, we're not going to give anybody else access to our models either because we think they're getting quite good. Take that, world. The interesting thing here is, some people were sort of comparing this to what's happening with rare earths, and is China trying to restrict access to these models in a way to use it as a lever in trade, especially Europe. We've become quite dependent on these open source models, and they're very good, and we use them for lots of stuff. But I think as leverage goes, it's different from rare earths because it's much easier to substitute. And I think what's interesting in all of this is to look at the role of Nvidia. Now, Nvidia, obviously formidable, sits at the foundation of all of this stuff. And Jensen Huang, he said repeatedly, look, we are not here to build the best model in the world. We are going to be near the frontier. They've got their open source model and their Nemotron, which is a fantastic model that they're releasing, and people can then build on that and use that and enhance that. Now, one of the reasons they've been holding back from pushing that model to the absolute frontier is because all their customers are the ones developing frontier models, and they're not looking to cannibalize their own customers necessarily. However, some of the restraints are dissolving. Anthropic, they're using silicon from Google and from Apple. OpenAI, they're taping out their own chip in partnership with Broadcom. And so some of the things that might have held NVIDIA back in the past look like they're going away. And so, one of the, if you sort of just look at the game theory of this, if China pulls back from supplying the world with open source models, and if all the US frontier labs are taping their own chips for inference, well, what I expect will happen is NVIDIA will simply step up the Nemotron efforts and will flood the market with their model. Why? Because it's the complement to their GPUs. And if the world has access to super cheap, super commoditized inference models, well, we're all going to be buying a lot more GPUs, and Nvidia wins. And so I was a bit surprised by the noise coming out of China, because I think it's pretty easy to see where this will go. And now it's important to say there's not been a decision yet. It's just rumors and speculation. But if China ends up restricting access to their frontier models, I think Nvidia will end up becoming the big winner.
I'm conscious that you have chastised me already that I'm being too much of a downer on this pod, but Mads, putting it back to you, isn't this like really gonna show how exposed Europe and the rest of the world is, right? If people have been increasingly relying on the open source models from China, especially where we've seen the US government restrict access to the frontier models, if the Chinese start doing exactly the same thing, isn't Europe's absolute failure to build critical capacity in this area like woefully exposed? Or am I missing something?
Yeah. Look, the question is how hard it is to fork existing models and enhance them from there. We know that more and more stuff is happening. I do think that kind of the core, the pure model layer is commoditizing. True. And, we could take a Nemotron and fork that and enhance that. I don't think we are as exposed as we are on some of the, rare earths and some of the kind of more physical supply chain issues where there isn't a, readily available commodity complement you can just pick up and kind of use instead.
Yeah, I'm with you on that one.
But we obviously we need power, we need data centers. I think the kind of the raw capacity to manufacture intelligence, if you will, like produce it and have it available is super, super important. And if you have gaps across the full stack, no semiconductors, no data centers, no power, no model, it's kind of like, what are you doing? So yes, we have fallen behind them. We need to catch up, but I don't think models in themselves is what will make or break this game.
Yeah, and for the avoidance of doubt, just because they will be restricting access to the new models that come out. I mean, the models that are already open source and accessible, of course, you can still, those they're already in the public domain, right? So
the cat's out of the bag.
Exactly.
And you can take them and you can enhance them. So you can build on what's already there.
Yeah.
And you can see, I mean, Prism ML are an exact example of this. They have taken a Chinese model, improved on it, and then now Americanized it. And now obviously Apple are in talks to how they can work with them and bring it into the iPhone range. So I think, the genie is out, I think, is the answer. Any other thoughts on this one before we move into pensions?
No, 100%. I mean, look, we're upside, but if we are sort of just picking, putting our tinfoil hats on for a minute and thinking about, okay, what's the doomsday scenario in all of this? Is that the whole industry is waiting with bated breath for the IPOs of Anthropic and OpenAI. Why? Because there's so much money locked up in these companies, and all the family offices and institutions that provide capital to the ecosystem for the last 18 months, I mean, they've sort of just been running there. Well, let's just buy some more Anthropic. Let's just buy some more OpenAI, right? Yeah. Hundreds of billions have been flowing into that. Everybody's waiting for the big payday. So there is an IPO enhanced for both of those companies coming up ahead. But if there is a race to commoditize their product, what is that going to do to the ability to IPO? Now, OpenAI have already said, look, maybe it won't be this year, maybe it'll be next year. Anthropic, we haven't heard or seen as much flip-flopping yet, but clearly they were keen to get Fable out, get that re-released, because they know they have to keep driving the revenue line. That is what unlocks the IPO. So if I were them, I would get out, get to market ASAP. I think it's super important for them and for the world. But hopefully, hopefully they can get it done. I do think sometimes there's more inertia in this than it would seem like if you just look at it at face value. So I don't think the fact that, open source models are getting very good means that their revenue will collapse overnight. But you can see where the train is going. Like the ability to keep monetizing something when there is something pretty comparable at a 10th or a 20th of the price. Yeah. At the end of the day, the loss of physics and supply and demand will kick in.
You think it's squeaky bum time at basically Anthropic HQ?
I think we have seen them be very aggressive about going after and moving into the application stack, something we'd always said they would be. I think they have offended a lot of people. I mean, if you go over to talk to Dylan Feld at Figma HQ, he's not a big Anthropic fan these days. And of course, the more they go into the application stack, which are the people that today are buying their tech, the more of their customers they're going to offend. So they're running a bit of a precarious game, and not unlike kind of the battles IBM were in the days of old and Microsoft were in the days of old, when those behemoths at the time managed to upset, a huge swathe of what should have been their customer base.
But they kind of have no choice, do they? I mean, this is going to be, at some point, the cost of tokens is going to be negligible.
I don't think they do.
So what an interesting time.
In the meantime,
of life.
all of my secondaries and family office WhatsApp groups are just full of people throwing tens, hundreds of millions into those two companies, mainly Anthropic, actually.
Are they listing this year, do we know?
Orders being posted in these WhatsApp groups for like massive strips of these companies is insane.
I get it.
Yeah, I mean, I think they're a little late to the party. I think
course.
sort of 6 months ago, 12 months ago is it would have been the good time. I think now, given the valuation and given where they are, it feels like it's a much riskier bet you're making. They both companies have filed, right? Confidentially, kind of S1s.
But it's not going to be 26 though, is it, Matt?
It's supposed to be
Anthropic,
26.
from what we know, is still the target. OpenAI have now said maybe not.
Interesting. I thought they were both kind of kicking it at the 27 territory. Listen, it's already July, so we've only got 6 months of the year left.
It can go very quickly once the decision is made.
Yeah, fair. To be fair, just to preempt this next segment, I have slight happy ears on, to use one of your phrases, Mads. So I don't want to talk about pensions piling into UK markets, although piling in is possibly a bit strong. However, this week, we've seen the most boring people in Britain do something I think is quite interesting. Pension funds have started buying venture. Okay, it's not much, bear with. Nest, the workplace pension for 14 million Brits. They've got 68 billion under management, have committed 200 million to a dedicated VC sleeve with Schroders. Growing to $1 billion by 2030. I know small beans, still stay with me. Their first names in the portfolio, Synthesian Wave, okay, big guys, not the wildest of bets. It's quite safe money, but it's a start. We've seen this before. We saw the Mansion House Compact, we've seen the Mansion House Accord, where 17 providers then pledged up to 10% of default funds into private markets by 2030. We live in dog years almost. That's a long way away. But half of that going into the UK, which is great news. Roughly 50 billion pledged. Now, for some context, 3 years ago, DC schemes had about 0.36%, 0.36% of funds in unlisted equities. That's our world. Last year, that doubled. So we went from 800 million to 1.6 billion. Yes, nothing to nothing. But we saw, obviously, in April, the BBB, the British Growth Partnership, hit its first close at 200 million with Aegon and Coercion, first ever VC investments. BBB, the British Business Bank, were looking to pull 2 billion of pension money into venture over the next 5 years. We saw the Pension Schemes Act passed in April. It's a bit of a gun on the table saying, come on, guys and girls, or we're going to make you. So my take is 3 years from now, pension capital will still be low. It'll be in the single digits, but it'll be billions a year into UK venture, starting safe and the Bs and beyond, so up the tree from us down in seed and early stage. But we will see it come down when we get some kind of fund structure, like France's Tibby scheme, where France is doing great things here that we've always promised but have never quite built. So, Lomax, can you tee that up a little bit better than I did, please?
I think you did a very elegant job there. But I would say
Bless you, my man.
I would say that, look, and the backdrop here is that when in the US, and we keep referring to the US, but clearly it's not to be ignored when they keep churning out companies like Anthropic and OpenAI and SpaceX, is when they loosened up the rules, allowing pension funds to invest more in private markets, particularly in private equity and venture, back in the 70s and 80s, eventually unlocked, married with strong performance. I always say this, you need strong performance to entice these managers to actually invest in the asset class.
But that becomes chicken and egg, Lomax, doesn't it?
So sure, fine, but you need both. And that has unlocked a motherlode of capital into the US venture ecosystem, such that it is anywhere between 5 and 10 times, at least 10 times the size of the UK, 5 times the size of Europe. So we have been talking a lot here about the fact that there is roughly, I think, $4 billion, 3 trillion pounds, $4 trillion of capital in the DC and DB pension schemes in the UK, and a tiny, tiny, tiny fraction of that is allocated to privates. And within privates, because privates, of course, consists of private equity, infrastructure, private credit, VC is an even smaller sleeve in that. Of course, with the Mansion House Accords, so the two agreements slash voluntary petitions, the chant that Rachel Reeves and before her Jeremy Hunt got the pension trustees to sign up to, there's been more of a push, obviously, to push the capital into these areas, into these critical areas. So this is part of that. Nest, 68 billion AUM, largest pension scheme by membership, 14 million members, is allocating, but this is 200 million, right? So it's a laughably small amount of money in the context of something that's nearly $100 billion in AUM. You got to start somewhere, I guess. I would say this is a very, very small amount of money. And also, not only that, it's going into the probably less risky end of the spectrum. It's going to the companies. This is going into late stage venture deals at Series B, C, D, probably C, D, E, when the risk is much lower. So it's actually arguably going to companies that are less risky and probably don't need the money, or at least, could get the money elsewhere, like Wave AI, Synthesia, like great companies, and we should be funding them. But actually, if you wanted to encourage pension funds to, pension fund capital to unlock and move the ecosystem in the UK, you want them to be investing in earlier stage, right? So in managers, ideally, I don't think they should be in direct deals. That would be madness. But investing either into fund of funds or into probably fund of funds, not into individual funds. That would probably also be madness, into individual seed funds. So it's a start. They're doing the less risky thing. I guess that's fine. They need to show performance. As I said, this stuff is only going to work if the capital performs. If you're sitting in Nest and you're the one that championed this, you need to show results. And the problem with venture is it can sometimes take 10 years to show results. So if you do a bunch of early stage funds, you could actually wait 10 years before you kind of everyone's like, oh, let's put more money in. So in a way, it kind of makes sense maybe to do the later stage deals where you actually see the markups on the results within 24 months. And then you can drive decision-making internally to allocate more capital.
Isn't there a challenge, though, that they're also coming in, and we're going to talk about this later in the show, but isn't there a challenge they're coming in top of the market?
That's a risk, yeah, which is why they should be, phasing this in. I mean, this is I would hope that these people, obviously, you need to give temporal diversification in any kind of investment. That they're committing the 200 million, but they're not deploying it all this year. At least I hope they're not. They will probably have a kind of 3 to 4 year deployment period for that, I would hope. But they are investing companies with Synthesia's, I guess it depends what the multiple is on the company, but these are proper tech companies. These are not speculative deep tech companies.
I welcome it. I mean, I think there is going to be more movement. I think we've missed the boat. But Mads, what are your thoughts on this one?
A couple of different thoughts. In terms of where they invest, and is it a problem that they invest at later stages? I'd say I think it's fine. It's always a capital ladder. More money at C means that Series B investors get a better market. They get a better market. That means that Series A investors have a better market. If they have a better market, there'll be more capital for them to invest in the stuff we have that graduates from seed. So I think if
I'd rather it was us, right? I'd rather it was us and it not going to the American 401ks and the American investors. At least it's staying in the UK. At least we know there's money from us staying here.
Look, it's supply and demand, and we know there's already some supply of capital today. And if that supply increases, that will benefit the whole stack. So I think that's fine. I think one of the things you brought up, Dan, is around this gun that's on the table in terms of forcing and mandation. And I think that's the wrong answer. We should use incentives rather than coercion. And there's so many ways you can incentivize this in the right way. The worry I have is that if it's forced, all that's being said is that they need to invest up to 10% in private markets. and up to 5% of that being UK specific. But you know what? You can comply on that by putting a lot of money into infrastructure.
Private credit.
Venture might never see any of that.
They put 500 million into private credit, so more than double what they put into venture just now. And arguably, private credit is a massive bubble, right? So
yeah, struggling at the moment. Yeah,
so I'm not sure that the forcing function really works. And then there's the whole question around: is it just socialism? And you've got the whole model where pension funds are raising money, investing money into co-investment structures that are managed by the British Business Bank and maybe other government entities. And I think it's good to get more capital into the market. I think it'd be better if the sovereign wealth funds, sovereign wealth institutions invested public money. And what do I mean by that? Well, today we have massive unfunded pension liabilities. Instead of the government having a lot of unfunded pension liabilities, put money aside, have a proper arm's length sovereign wealth fund invest the capital so it can be used for pensions in the future. I think that would be better than trying to take the private capital that exists and then for the government to sort of playing it of being a fund manager, which I'm not sure is the right model. So, look, some movements in the right direction, but it feels like there's still so much work to do here to get this to work properly.
And also, it's not just pension funds. We need to get other institutional cash moving around, although pensions, as we know, is the major unlock.
Nest takes in 700 million a month in contributions, defined contribution scheme. Here they are putting 200 million into venture. One thing that's very interesting about Nest, though, actually, Nest already has pretty high allocation to privates versus other pension funds. So actually, they're already at like 20% privates, but it's mostly not in venture. Obviously, it's in infrastructure and private credit.
I want to do something a bit tricksy. We often have talked a lot on this pod about froth in the market. Are we top of the market? Is this the .com? Is there a story to be told here? So what I've done is I've put 10 reasons why it is 1999. So I've tried to put 10, what I think are the top 10 reasons. Yes, it is. It's frothy. We're in trouble. This is super crazy bubble territory. I've also written no, it's not. And I've done 10 for a yes and a 10 for no. So what I'm going to do is very, very quickly give you both the 10 yeses. And then I'd like you both to chime in on each of the elemental points as to what you agree with, disagree with, and unpack things that maybe aren't so common in the public discourse. And then we'll do the same for the no's. So on the yeses, it is 1999. This is top of the market. It's froth. It's crazy bubble territory. So the Schiller index just flashed red. The CAPE ratio, the price to earnings ratio, has just crossed 40 for only the second time in history. Last time was in December 1999, just before the NASDAQ lost 78% of its value. A leaked draft this week from the Treasury likens AI to the dot-com bubble. So the powers that be are talking about this. Money is chasing its own tail. This is number 3. Over 800 billion of AI deals are now circular, e.g. Nvidia puts 100 billion into OpenAI. OpenAI fills its data centers with Nvidia chips. Or central banks are saying it. Taiwan Central Bank, BOE, even the BIS warned in late June that the bubble could pop and take the global economy with it. Concentration looks the same as the dot-com. AI Big 10 are now 40% of the S&P. The CapEx metric is already past 2000. CapEx to sales hit 32% at the dot-com peak. AI is projected to hit 34% this year. Burn rate, OpenAI is reportedly losing 12 billion a quarter, on track 14 billion this year, against roughly 1.4 trillion in data center commits. Debt has now entered the story. Big tech is no longer the cash machine. Lending is happening. OpenAI borrowing $520 million. Hyperscalers now carrying $1 trillion in undisclosed data center leases. The cracks are showing. Nvidia shed almost $1 trillion in under 2 months. Oracle, the most exposed hyperscaler, is down 40% in a month. And finally, the silly money is moving in. Blue Origin, maybe you've seen this, now raising 10 billion at 130. So they are my 10 top reasons for yes, it's crazy town. It is 1999. The bubble is going to pop. Mads, what do you say to the 10 yeses?
Can make lots of arguments on either side.
You politician, you, I love you.
Well, I mean, look, economists have predicted 9 of the last 5 recessions,
I
right?
love
mean,
that quote. I love
there
that
are
quote.
always lots of reasons why stuff isn't going to work. And I think trying to predict the top of the market is a little bit of a fool's errand. I don't know if anybody can ever truly do that, because booms that can turn into bubbles often have a lot longer to run than people think. Now, it's interesting that the BIS, kind of the Bank of International Settlements, they are talking about this being a bubble and a mania. They're talking about the canal mania, the railway mania, the dot-com, kind of all these infrastructure manias that always work out in the same way every time, which is they drive a lot of capital into infrastructure, and the people that fund that capital, that provide the capital and build out all the infrastructure, they end up losing their shirt. But the world at large that ends up with a lot of infrastructure that's built out and benefits the economy and drives growth in the years after that. And so
just to qualify, Mads, just for those that don't know, the BIS, so I didn't know until researching this segment, the BIS is like the central banks of central banks, a Swiss-based organization. Is that fair?
Yeah.
Yeah. Okay. So if you didn't know, that's what the BIS was. I had to look that up. So the BIS is like the big daddy to all the central banks.
And look, we're seeing some crazy town things happening. So SK Hynix, they've IPO'd now, right, in the US via the ADRs. And what is an ADR? Well, it's a way for a company that's listed somewhere else in the world to also list in the US and be traded in the US. And immediately following the listing, an ETF arrives that allows retail investors to invest in SK Hynix on a 2x leverage. It's bubble stuff. I mean, you can't get around that.
Yeah,
and these companies are seesawing up and down. Right? Even Samsung, which is a formidable company, I think is sometimes swinging more than 5% a day. Right? For a company that size, it just sort of tells you something about how volatile the market is. At the same time, we know that AI is world transformative. We see it every day. We see revenue growing for these companies. There is going to be a lot of value still to come. And yes, there is some concerns around whether SK Hynix and Micron and Samsung on the memory side can keep up the formidable growth and profitability they have. But I don't think anybody really expects sales to slow down this side of 2028. All we're discussing is at some point in the next few years, growth is going to stall. Nobody is suggesting that revenue will totally collapse. So you could argue it either way. I think if I was going to go back to some of the stuff we talked about last year, yes, this is certainly boom territory. Some of the stuff looks very bubblish. The opportunities are very real. And I think what will come out of it is there's going to be a painful consolidation across some of these things. We discussed some of it earlier in the pod. What is going to happen to the frontier labs? Can they keep climbing up the value stack into applications and take enough value there that they can create enough of a moat that they won't be displaced by commoditizing foundation models? And then, of course, you've got the hyperscalers that are doing, all the CapEx build out and now started to go from kind of funding that with free cash flows to funding it with debt to actually now issuing equity. I mean, could you believe Google issuing shares? The company were printing so much money, they've never found a way to spend it. Now they're issuing equity.
And bonds,
but bonds is one thing, right? But issuing equity for a company like that is just not something you thought you'd see. We're seeing lots of retail activity. Kind of this that tell, right? Kind of the fourth horseman of the apocalypse of an impending doom is kind of when you see retail piling in, when you see corporates selling their equity, right? I mean, those are kind of two of the key ones. So yeah, it could be lots of arguments why this is the top. The market will top at some point. Okay, nothing keeps going up forever. I just don't think we know for sure whether it's this summer or Q3 or Q4 or Q1 or exactly when it happens. Who knows?
Lomax, it is 1999.
Well, I think, so I was just picking up on a few things that you said. First of all, the central banks, I mean, it's kind of in their job description to be harbingers of doom, or at least to hold everyone.
Harbingers of calm.
Yeah, harbingers of calm, at least rein everyone in a little bit and get everyone a little bit back over their skis. So, even if you look back in the 90s, Greenspan was warning against irrational exuberance in 1996, right? So he was, 3 years early. If you look at, there's some things that are interesting to look at when you are drawing the comparison. The problem is comparisons only work to a certain extent, right? It's useful, it's informative, but clearly what has happened and what will happen will unfold very, very differently. So we should be careful about leaning too heavily into the analogy. But, NASDAQ is up 115% since ChatGPT. Actually, post Netscape in the 90s, NASDAQ was up 700%. So the kind of the growth, yes, we've seen huge growth, but nowhere near what we saw in the 90s. The biggest thing to worry about is which is similar to last time, is that you end up with a lot of extreme amount of capex, not which cannot be justified. Here, of course, we do have real revenues underpinning many of these companies, unlike pets.com, Webvan, etc. back in the day. However, the sheer ratio of capex to revenue is a little bit off kilter. No, if we're talking about 70 to 80 billion dollars of AI revenue at the moment, depending on how you define it, with trillions of capex going into the ground, that growth rate has got to carry on pretty steeply to justify the capex against the backdrop of commoditization of the models. That is something that could leave us on a bit of a sticky wicket.
I'd say our Anthropic bills have started increasing so much now that we are starting to look at whether we can switch more workload off to other models or onto open source. And look, the truth is the model is one thing, but the scaffolding, the kind of the Claude code, all the harnesses, all the stuff that sits around, that's really where you get some of the lock-in. Because once you've got your whole setup, you're just not likely to switch out of it. And so I think it's stickier than just the raw model performance would have you believe.
Yeah, but that sounds like an opportunity for some smart founders, though, Mads.
Yeah, I think it's a fairly fairly battled over battleground, if you will. I mean, what's the open gap in that particular market today somebody would go after? I don't know. Anything top of mind for you?
No, I think as you see with all great things, especially in software, you see this kind of great bundling, this great unbundling, then you see this aggregation, then this disaggregation. So I think there is going to be, as the commoditization becomes more known, integrated, available, and then you're going to get these great tools, which, like you say, are already out there that are enabling a little bit of this on-prem, a little bit of this super duper Anthropic this, a little bit of this OpenAI super duper that, a little bit of this Quen or whatever it might be. So I think we're going to see this kind of blended approach, which I think will, obviously for us, would ease the monthly costs, and I think that's where enterprise is going to end up. They're going to end up in this kind of slightly more blended approach. But I do sound like a broken record on that one. Let's move on to the no's. This is the no. It's not 1999 top 10. The technology already works. We've talked about this in the .com. There was a lot of nonsense. The tech is working. We can see it. The leaders are the most profitable companies in history. And up until recently, the Microsoft, the Alphabets, the Metas, the Amazons, they've all been paying for the build out free cash flow. Real usage, not eyeballs. In 99, the metric was page views that never really did anything. We're already seeing trillions of tokens per week in usage. Valuations, I think to your point, Lomax valuations are less than half the .com peak. The Nasdaq forward earnings multiple around 23 to 24x today versus 60 to 70x in March 2000. Fastest revenue ramps ever built. We're looking at 20 billion ARR from OpenAI, Anthropic through past 9 billion, scaling in 3 years, what Amazon took a decade to reach. Demand is already physically constrained, so classically bubbles are not that. They're infinite hype, chasing infinite supply. We have some limits in the box. They've got a chunk of demand that can't leave, so we're seeing governments now treat compute as national infrastructure, so there's a solid base to this. Even the bears concede the fundamentals. Leaked Treasury report also admits today that AI firms are more mature, profitable, and better capitalized than their 90s peers or reflections. Retail isn't really holding the bag just yet. There are fewer small investors that are directly exposed. And last on the list, even if, maybe to your point, Mads, even if we do overbuild on the CapEx front, it won't be wasted. The dot-com fiber glut took years to reach its usage, but this is going to be used almost instantaneously. So they were my top 10 for it's not 1999. Now, Mads, you've answered a lot of these already, but any closing points or any conclusions before I hand over to Lomax?
Nothing. I think you've said it all, Dan. Yeah, there is clearly, so I think the main difference between now and 1999 is that today the technology is being used and is useful and generating more revenue much earlier in the cycle. In 1999, we had a big build out that was being used to generate eyeball metrics. Today, it's being used to generate revenue. May not be profitable revenue yet, but it's real money and revenue growth rates are formidable. Huge difference.
We've got a little bit of an old friend. We've got AI Corner coming back. Mads, your happy place. There's only one item in AI Corner, which is basically our normal Anthropic check-in. So we saw Fable 5 leaving subscription plans, then coming back, Sonnet 5 shipping, ID verification went live on Wednesday. What's the latest with Anthropic?
I think you've rounded it up, Dan. I mean, we should probably have had the OpenAI model release in here as well. We pretty much talked about AI on the whole show. But yes, Fable 5 is back. Long may it live. It's a formidable model. It's also
incredible.
really, really expensive. I have never seen anything chew through credits this fast. I mean,
I've
it's
seen
scary.
the email warnings. I've seen all the warnings coming in. You've hit 75% of your... I only asked 2 things. It's crazy.
Yeah. So that's a whole new story. But it's out, and then what they're doing effectively is they're releasing Sonnet 5, which is also a really good model on the cheap. So basically, Fable 5 pitched at the high end, trying to figure out just how elastic is AI demand. Can we charge 5x the price for tokens on a really token-hungry model and get away with it? So that's the test at Fable at the high end. And then they're using Sonnet 5 to mop up at a fifth of the price at the lower end to say, listen, if you want great models and great intelligence at just a notch behind the frontier at a fifth of the price, then you can switch over here. So it's an interesting experiment they're running.
Nice. Well done. Hopefully you can keep the money rolling in, Anthropic. Matt, you put a note here about a Lisbon story.
Well, it's because you guys are in Lisbon, and I was suitably envious. And so I thought, what's an interesting story about Lisbon I can share? In 1755, there was an earthquake and then a tsunami and then fires for days in Lisbon. And the city got flattened completely. Did you know that, Lomax?
I didn't know that.
Of course, I think about it a lot living here. It was actually on All Souls Day, the 1st of November, which led to a couple of things. One is all the churches were prepared for service, so all the candles were out, right? Which led to all the assisted with all the aggravated all of the fires. And secondly, because it was on All Souls Day, it meant people felt it was particularly the God-fearing folk of Lisbon, particularly ominous.
But there's so that's the sad part of it. There's an interesting kind of, for geeks and engineers and technologists like us, there's a really interesting story, which is that the king at the time, he had sort of a prime minister called Pombal. And he said, he had his chief military engineer, Manuel de Maya. He said, listen, you got to work this out. Can't have this again. And so de Maya, he set off to find a way to make the city more resistant to future earthquakes. And in fact, he built something called Gaiola Pombalina, or like your Portuguese is probably better than my Lomax. The idea was to create a flexible timber cage hidden inside the masonry of the building to absorb some of the seismic shocks. And so they figured out a way to build the cage, and they had soldiers sort of trample around and sink to fake the tremors, which was sort of the first structural earthquake test in history. So kind of using the army as a shake table. And so what happened was that when the Baisha went up again, they used this technology, which was effectively sort of partly a prefabricated components using this construction approach, which is, we believe, the first industrial prefab construction in history, sort of before industry really took over. And so in some way, you could say that Lisbon took that opportunity to answer catastrophe with and kind of engineering and with a new engineering standard that led to fast rebuild and much more resilient constructions. And so I just thought that was a nice story to share today.
What a lovely history lesson. Thank you so much.
It's very cool. And it reminds you that, but if you go back to the 16th century, Lisbon was effectively the Silicon Valley of Europe, back when navigation, seafaring were the real frontier technologies.
Yeah, you forget that.
Lisbon
was
how big Portugal was. The place to be for that. Yeah, the Gaiolo, means birdcage. So you can see why the what Mads is talking about. The problem, I would say, is having lived in Tokyo and experienced many earthquakes at the top of skyscrapers where you're, where you're rocking from side to side. Sadly, the technology has not quite caught up today. I think we're probably still relying on these wooden bird cages. And so that's the slight, but I do think Lisbon is a little bit exposed to a big future shock. In the 4 years that I've lived here, we have had 2 kind of noticeable shakes, but nothing the size of 1755.
I didn't know that it was so seismic. I remember being in Tokyo in an earth tremor and the wardrobe doors opening. And I also remember being in a hotel in Tokyo, and I couldn't quite work out why the bathrooms were this weird kind of almost oval plastic. And it was a really high-end premium hotel. So I asked the reception, I said, why are the bathrooms made this way? And apparently they're like a string of pearls. So if the building collapses in an earthquake, you go into the bathroom, which is like a sealed container, and the rescuers can lift all of the bathrooms out of the rubble, and they're like little protection cocoons. And I thought that was quite an interesting architectural.
You don't have that here.
Yeah, that was an
interesting thing about, you talked about the Marques de Pombal, who was this very sort of revolutionary figure. The other thing he did, he when Baisha, the low area, got completely flattened by the tsunami, it was a kind of hodgepodge, higgledy-piggledy bunch of streets and alleys. He flattened it and he built the city on a grid pattern. And so if you go to Baixo and Lisbon today, even though you've got on the hills very higgledy-piggledy settlements, Baixo is absolute American style grid pattern in a way that actually many European cities aren't, because European cities generally just evolved organically over time. So that's why Baixo basically had this clean out, and then Marques Pombal put this pretty much one of the first proper grid city layouts in Europe.
We are going to set up a new podcast all about the history of tech.
Yeah.
There you go.
Oh, well, there you go. The rest is history meets upside. There is an amazing museum. If your kids are for me, for a big kid like me, I love it. And actually got my wife to take me there on my birthday. But there's a museum called the Quake Museum in Lisbon, where you can actually go and relive the earthquake. You actually go into a mock-up. You got what? They've rebuilt parts of the city.
That sounds horrific.
Yeah, it is actually. You go into a church and you've got the kind, and they but for children, I don't know, the age of 10 to 15, it's sort of a cool experience.
Yeah, they'd love that. Let's get back onto the tech, boys. We're just about to round off. But I love that. Thank you for the distraction. I've got one thing.
While we are in Lisbon, I happily give you an overview of the tech ecosystem here for 3 minutes, if that's helpful.
Do it.
So there's been a lot of talk about Lisbon over the years being a tech center. I think clearly there's a lot of interesting things going on here. And Portugal, if you look at unicorns per capita, or unicorns as a proportion of GDP, is probably one of the highest ranking countries in Europe after Sweden, probably. As a reminder, Portugal has roughly 10 million people, so the same size as Sweden. You've had 7 multi-billion-dollar companies or unicorns emerge from the ecosystem. And so probably the latest example is remote.com, Sword Health, which is a big kind of digital health company doing hundreds of millions of revenue now, backed by Khosla. So you've had some big outcomes from a relatively small ecosystem. Only about 400 to 500 million gets deployed here every year. If you compare that to wider Europe of 50 bits, less than 1% effectively of the European market. But what you have is a disproportionately high number of unicorns, but you also have a kind of clustering of exited founders, GPs who live on a plane anyway, and so use this as a base. So I think on the investor side, you have a really kind of interesting group of people to swap notes with. So it's a wonderful place to live. It's a great place to bring up a family. And as a tech ecosystem, it's got nowhere near the size or depth of capital of Berlin, Paris, London, Stockholm. But there are some interesting things going on here for sure.
But it is funny that you put Stockholm in that pot because it's only relatively recently that you'd have put Stockholm in that pot.
Kind of, but I mean, Spotify is not exactly a recent phenomenon.
No, that's 15
North
Klarna.
North Klarna. Yeah. And actually, I would say in our portfolio, we've got 60 companies in our portfolio. We've backed one Portuguese founder, and he's the best performing founder in the portfolio. I mean, he's moved to the US because he needed to. But I'm kind of proud and happy of that. But Portugal does produce some amazing entrepreneurs. Many of them leave, but still.
I've got one very quick prediction after everything we said. So my prediction is that Europe has an opportunity to win as the bubble pops, deflates, whichever way you're gonna view that. So the last bubble gave us the fiber, obviously powering 2 decades of growth. Now, I think with this commoditized superintelligence, sure, that's a global offering, but I do think that Europe has the opportunity to lean into real-world applications, industrial depth, and get into regulated workflows. Said it before, but today's research just reinforced it a little bit stronger for me, that I think Europe is not, has got a real opportunity here to make some real inroads at an exciting time to be alive in tech. Mads, what is your deal of the week?
Company called Luffy AI. They've just raised an 8.1 million pound Series A, and they make self-tuning AI control for industrial electric motors, which obviously is an interesting thing. So yes, that's the one I would highlight.
Luffy, lovely. Lomax, what is yours?
An absolute monster. It's Germany, or specifically Munich's Proxima Fusion, raises 411 million euros. So I guess that's over $500 million at a $2.5 billion valuation, the largest fusion round ever in Europe. And one of the biggest European tech rounds of the year, led by XTX Ventures. It's actually a relatively young company. It's only 2-3 years old, and very
good for them.
It's very cool. We actually often talk about Europe's inability to build large deep tech companies, the likes of SpaceX.
But we have also at the same time said, Lomax, that quantum and fusion are possibly going to be somewhere that Europe can play.
Yeah, exactly.
And I think these are proving the point.
What I was going to say was, you have that, and then like companies like Northvolt kind of continue that that narrative. But if we can like buck the trend with companies like this, as you say, quantum, there's some. Well, IQM, I think, just did an IPO this week, no? In Finland.
Was it this week?
Recently.
Last week. Yes,
last week. So for sure, could be.
Nice.
There's a lot of money that still needs to go into that pre-revenue. So people are going to need to hold their nerve on that one.
Yeah, I bet. Well, it's fusion, huh? Mine is also a Munich business. It's Quantum Diamonds. They raised 91 million this week to scale semiconductor inspection tech. Now, only 15 million is actual equity. The rest is kind of some kind of pseudo government-backed package. However, following the ASML playbook and in quantum and creating value today, I say bon chance and go for it. Quantum Diamonds from Munich.
And
anything else?
Yeah, I would add, you called, so Blue Origin, Jeff Bezos' launch company, raised 10 billion at 130 billion. Now, you referred to that earlier on in the pod as sort of being symptomatic of the, or emblematic of the bubble that we're in.
Crazy.
But I mean, really? I mean, it's raising at a tenth of the price of, not even a tenth of, like 5% of the price of SpaceX.
Sure. And I saw Eric Schmidt's, I can't remember what Eric Schmidt's, it's something called like the Rocket Company. So it's got a very basic name. But he's kind of slid under the radar as well, raising a big chunk of change.
Well, he basically took control and recapped a rocket company, which he now owns a lot of. But, if you put it in the context of the SpaceX valuation, then Blue Origin is relatively well priced. But I guess you would argue that Blue Origin is just at the moment a launch business, and SpaceX really the driver of value is Starlink and not the launch business.
Yes.
So on that basis, then maybe it does look a bit pricey. Still, it's an interesting, SpaceX is going to have some more competition going forwards.
Yeah. I also saw that the Chinese have offered the Russians a competitor to Starlink. I don't know where they've got to with it, but there's the tiny European activity. There's a lot more activity going on in China to produce that kind of what will become, I imagine, some kind of eye in the sky. So that'll be interesting to see how that pans out as well. Mads, what's happening this week that we need to keep an eye out for?
Tuesday is big macro day in the US. You have the US CPI being released. You have 5 big banks announcing earnings. You have Walsh's first testimony, the new governor of the Fed. So that'll give us a read of the US economy, which is, although we in Europe, of course, is still the driver of the global economy and therefore very important. We also have some real AI capex verdicts. Both ASML and TSMC are reporting next week. ASML Wednesday, TSMC Thursday. It's going to be interesting to see. We got more news on the Volkswagen debacle here. There's an investor call on Monday. So there's sort of a showdown around what's going to happen. Will they be able to restructure and cut costs or not? And then, of course, most importantly of all, we have the continuation of the FIFA World Cup and some exciting matches coming up.
So we're moving from history to sport. I'm loving it. Upside is moving and shaking. Let's go for it, boys.
Looking forward to that.
So that's, so at time of pod, England is playing on Saturday, so it's tomorrow. Ooh. But I mean, that is it, I think, lovely people. Anything more before we close off?
Who do you support in the football, Mads? You support England, though, surely over Norway.
Of course.
Norway, Denmark. Don't call him Norwegian.
No, I know. But Norway used to be part of the Danish Empire, no?
That's true. Once upon a time, yes.
Well, Danes used to own everybody.
100 years ago, no? Or something like that, right?
Yeah, for a long time too, yeah.
Back into the history lessons, loving it. Gents, thank you so much for your time. And for everybody listening and watching, we will catch you next week.
See you in the next one.
Bye.
Upside!